This is Eat, Sleep, Invest, the marketing podcast for real estate investors to get more deals. Hey, welcome back, everyone, to another episode of Eat, Sleep, and Invest. I'm your host, Bryan Driscoll, and we're here with Jason Hartman today. What's going on, Jason?
Hey, Bryan, it's great to be with you. And let's talk about this potentially changing market. I don't know, maybe not.
Yeah, the times are tough. Times are not tough. Times are turbulent, we could say.
Yeah, they are. You know, interest rates have come up substantially. Of course, everyone's worried about that. Prices are way up. And so, the big question on most people's mind is this the bubble popping? Is that what we're seeing? Or is it going to keep on going and price is going to keep going up? So let's dive in and dissect that.
Yeah, sure. So, hey, Jason, why don't you give everyone like a short background on what all you're involved with? Because you're involved with a lot of different things.
Yeah, sure. So, my main business has always been real estate and real estate investing. And I started when I was in my first year of college. I got my real estate license just to learn more about investing. I didn't like being poor as a kid, so as an adult, I wanted to change that. And I was in the traditional business for many years. I had a traditional real estate company in Southern California. I sold it to Coldwell Banker, and I've been in the investment side of the business ever since. And my company, Empowered Investor, basically helps empower investors, as the name would imply. And we help people buy properties nationwide. And we do a lot of research to figure out what are the best markets to buy in, what are the best strategies to use in those markets. And then we offer a referral network. After we educate people, we offer a referral network where people can buy properties through our network. And our main strategy is buy and hold investing. We do teach a little bit of wholesaling as well, and that's what we help people do. We help them build big portfolios. We've got a client now who's well over 100 houses through our network and moving on to 500 single-family homes. That's what we do. And I also have a software company called Real Estate Tools that helps people analyze and track real estate deals once they own them. It helps them figure out if it's a good deal and then what to do with it afterwards. So that's
Nice.
the main stuff.
Nice. That's cool too, especially on the tools. Like a lot of guys in the earlier stages don't know how to figure out if it's a good deal or how to figure out cash flow, all that kind of stuff.
Yeah, absolutely.
So, Jason, what do you think is going on with the market?
Well, I think I have a visual aid that's going to probably illustrate that better than I can speak it, but I will, for the people listening on audio only, I will read it. And this is what I shared with you at that last mastermind meeting we were at. And that is this slide. And it's kind of a meme. I posted it on social media. It says, let's say there are 1,000 buyers who can afford a home with a 3% mortgage. There are 800 buyers who can afford it when the mortgage rates are 4%. But there are just 600 buyers who can afford it when the mortgage rates are 5%. None of this matters because there are only 100 homes for sale. and that sums it up. So, I mean, we'll go into this and unpack it a lot more. But, Bryan, so many people are talking about, oh gosh, the higher interest rates is going to change the housing market. It's going to cause a crash. And we are early in this. I mean, the rates, the big increases were really just over a month ago now, but it's not showing any signs of that happening yet. Now, at some point, the market will have a correction. No, it always does. There's always a cycle. I don't deny that for a moment. But by and large, given that people don't really understand whether real estate is cheap or expensive, and that's what I help teach them through an index I developed called the Hartman Comparison Index, or the HCI, the Hartman Comparison Index. And it's really a lot cheaper than most people think. When you compare it to a lot of other things. See, the mistake people make is they compare it only to one thing. What's that? The dollar. Why would you compare the value of real estate to only one thing, the US dollar, when the dollar is a moving target? The dollar's not the same as it was a year ago or 10 years ago or 50 years ago, for sure. So that's a moving target. So we've got to compare the price of real estate to a lot more things than just the dollar. That's super important. And the inventory levels are still so dramatically low that we've got to see inventory climb a lot before there is a concern that the market is changing. It's just not happening. Maybe it will in a while, but I think it's a ways away.
Yeah, I agree too. And you know what? That slide that you have up here talking about the amount of homes too, that is so true. It's like everyone's talking about, oh, the interest rates go up. If there aren't houses for everybody, like everyone's looking at, it's going to stay the same.
Yeah, so then, the natural question to ask when you think of something like this is, you look at these inventory numbers, right? We started off the year with just under 300,000 houses for sale. Now, this is the Altos research data. The National Association of Realtors, or NAR, calculates it differently. That's why you'll hear conflicting numbers on this. I don't like the way they calculate it because they include the pending and contingent sales. And granted, some of those will fall through and cycle back onto the market, but I think just the actual homes you can buy today is a better thing to look at. And then inventory got lower the end of the first quarter to where we had only 241,000 homes for sale. And what we need to see here is we need to see 900,000 to 1.5 million homes for sale to be in what we'll call a normal market. That's only normal. That's not a buyer's market. It's not a bad market. It's not a recessionary market. That's just normal. So we're not even close to normality in terms of inventory. We're still way, way below. When we see the inventory increase by 300 to 500%, then let's start to worry about the market correcting and changing.
Right.
But we're far from that.
Hey, and for everyone listening too, he's showing a chart here that shows there was like 1.1 million homes for sale back in 2015 and are on the market, and there's only 241,000 now. It's like a steady decline.
And just to give you some perspective, when I was selling houses to investors back in 2015, and long before that, of course, I was complaining about how bad the inventory level is back then and how there weren't enough choices for them to buy and how things were still selling on multiple offers. Because here's what this chart doesn't tell you, Bryan. It doesn't segment by price. When you segment by price, this becomes catastrophically worse, but in a good way if you're an investor, but worse for home buyers because the entry-level part of the housing market is even lower in terms of the inventory that's needed than this. Builders for the last 14 years have not been building entry-level houses. And of course, investors usually want entry-level houses because those make the best rental properties. So, when you segment by price, because this includes the high end, the low end, the middle, everything, right? This includes multi-million-dollar houses that are $5-10 million or, $1 million, whatever, right? It's all in here. This is the overall inventory. If you were to segment by price, you would see that the inventory is just so scarce for first-time buyers. It's truly unbelievable. It really is.
Yeah, it's crazy.
Yeah. It would be like that next picture, and I showed you this one before. It would be like walking into the grocery store and seeing 66 to 80% of the shelves empty. That's the real estate market we have. There's
that's great
just
analysis.
so little inventory. Yeah. And I predicted this year, at the beginning of the year, I predicted prices would go up by 12% this year and rents would go up by 8%. And you know what? I think I'm going to be right.
Yeah, I think you are too, just because even just so far in this year, everything's going up like crazy. And we're only in, 5 months in?
Yeah, I know.
What do you think on, so I get a lot of people talking to me too about rental properties. And rental properties, they've been holding them, they rent, they cash flow. And everyone's like, you know what? I got to cash out now. I'm going to cash out. I'm going to capitalize on the high prices because the housing market's going to drop or whatever. And they go and sell their entire portfolio. Is that a good move, or what do you think?
Well, it depends on their portfolio. To be fair, it depends where it is. It depends what price ranges, what types of properties, versus their management style and what they want to manage, right? So there are some personal elements and market elements in there, but just very generally, I think they're going to be very sorry they did that.
Yeah. What do you think's going to happen? Properties are just going to keep going for a while?
I think prices are going to keep going up. I think rents are going to keep going up. You know, the rents always lag the prices. So rents, prices appreciate much faster than rents appreciate. And if you think about it, here's one of the major reasons why. I mean, there are multiple reasons, but one of the major reasons is that, typically homes are rented on a 1-year lease. So the landlord can only raise the rent once a year, right?
Right.
But sales, the comparable sales prices increase constantly. So, for example, if you own a house in a given neighborhood, we'll call it Anywhere USA, right? And your neighbor decides to sell their house, and then down the street, someone else decides to sell their house 2 weeks later, right? In 1 month, in a rising market, you've got 2 new comps, 2 new comparison sales, right? And so those are escalating very quickly in an escalating market like this. But rents, that can only happen when the lease comes up for renewal.
That's a
Okay.
good point too. Yeah, because even like the properties I own and things, yeah, you're right. We only ever even decide to raise rent once a year,
Yeah.
if we even do. Like
Right.
a lot of times I don't even rent it because turnover is so expensive.
Yeah, but I'll tell you something. And normally I would say really try to keep your tenants. But the reality we're in now in the last year or two is that a lot of times you're actually going to be better off raising the rent and just suffering with the tenant move because the rents are so much higher that you actually can be much better off if the tenant moves and you get a new tenant at a higher rent.
Yeah,
It's
that's an
quite
interesting.
dramatic.
Yeah, that's an interesting point too. But yeah, because if you get somebody new in there, try to retain them, but you at least get that significant bump.
Right, you're starting from a higher level. So, and really, landlords should raise the rent every year, especially in inflationary environments, which is almost always. I mean, even when inflation is reported at official rates of 2 or 3%, the reality is it's at least double that in real life. I mean, we all know the inflation statistics are very manipulated. They're manipulated lower. They do this in 3 major ways: weighting, substitution, and hedonic indexing. So when they calculate the consumer price index, or the CPI, the most widely used measure of inflation, they want to manipulate it to make it look lower. And there are 2 major reasons for this. Number one, nowadays, unfortunately, the government is about 20% of the economy. So all of those government salaries are indexed to inflation. They get COLA, or cost of living increases, right? And then all of the government benefits, Social Security, et cetera, right, are indexed to inflation as well. So if they were to report the real inflation numbers, they would have to pay out a much higher rate on all of these things, right, which is a significant part of the federal and state and local budgets. But also, they just want to make people think things are better than they really are, right? Because that's going to keep the current people in power, and they want to keep their job. It's a pretty
Right.
cushy job working for the government and being a politician, where all you do is lie all day.
I'm with you there.
Yeah.
Hey, so I got a question for you here. So a lot of people we talk to are like, oh yeah, the American market, the real estate market, things like that. What do you think? Is there a American market or is it segmented per
Yeah,
city, per
good.
areas?
Yeah, good question. In a country as large and diverse as the US, there's no such thing as a real estate market. There's no housing market in the US. There's no US housing market. Okay. There are only local markets. The old saying in real estate is all real estate is local. But there are too many markets to keep track of. And with nearly 400 MSAs in the US, and over 3,100 counties in the US, and over 9,000 cities in the US, and countless neighborhoods beyond that. Where is the national housing market? I don't know. Is it Los Angeles, where I grew up? Is it Miami? Is it Boston? Is it Chicago? Is it Atlanta? Is it Phoenix? Seattle? I mean, show me where the national housing market is. It's all of these things, but you can at least get a better handle on it if you segment it into three types of markets: linear markets, cyclical markets, and hybrid markets. The linear markets are the ones we recommend. They're the markets where if you're looking at an appreciation chart, it's just kind of slow and steady, and it's pretty boring. It has little ups, little downs, nothing significant. The cyclical markets are like a roller coaster. The chart is really high, then really low, up, down, up, down, up, down over time. And the hybrid markets are in between the two. And linear markets are most of the country and most of the world. The hybrid market, or the cyclical markets are few in number, but they make the news. They get all the attention because they're spectacular, right? They're something to look at. A lot of stuff changes all the time, so there's a lot more reporting on them. And those markets are highly risky. They tend to have very bad cash flow, and they also tend to have very left-leaning governments where the landlords don't have any rights. And we want to invest in places that are friendly to our cause as landlords, where the government is going to enforce contracts. The courts will enforce contracts. And if someone doesn't pay the rent, they get kicked out and you replace them with somebody else who will pay the rent. But in these lefty-leaning places like my home state, the Socialist Republic of California, they view the landlord as the big evil landlord, and the tenant is always innocent and the landlord's always guilty. So those kind of places, you don't have too many rights as landlords to get people to keep their word and obey the contract.
Yeah, and I'm in Pittsburgh, so I would fall into the linear. Our market doesn't do much. Goes up a little bit, even back in 08. It didn't really get crushed like everybody else. It goes up a little teeny bit, nothing crazy.
Sure.
So that's interesting when people are looking at markets too.
Sure is. Yeah, definitely.
So you were talking about before, it's like, okay, we compare the dollar to real estate. Tell everybody what you're talking about there. Like, what else would you compare the dollar or compare real estate to find out?
Yeah. So, I think it's really important for people when they start thinking about the value of anything, not just real estate, just anything. I just ask a very fundamental question, and I'm sharing some slides here now again, so we can look at some things in depth. And for those listening on audio only, we'll just try and explain them as well as we can. But, how do you know how valuable anything is? How do we know this? Right? We know it because as actors, as economic actors in any marketplace, we go out into the marketplace, we buy and sell, we trade, right? And, that's how we know the value of something. Just intuitively, we're always thinking this in the back of our mind. It's like subconscious, right? Capitalism is such a natural thing. And that's why the system works much better than other systems that have been tried and failed, because we all inherently do this, right? And so when you look at the value of real estate and everybody says it's expensive, well, I ask, how do you know that? How do you know if it's expensive? How do you know if it's cheap? Well, I look at the dollar price, right? Well, a house in 1970 was only $23,000, and today it's almost $400,000. So it's expensive. Are you sure about that? Because the value of the dollar has declined so much since then that, maybe it's actually cheaper. Just because you're adding a zero to a dollar or a currency unit doesn't change the value of it. Okay. It doesn't make it more valuable, more expensive. It's just a symbol by which we trade, right? So my lesson is to say everybody needs to have the right measuring stick when they measure something. That's how they're really going to know if something's valuable or not. So let's unpack this more, right? I'm always saying this question: compared to what? I'm always asking that question. And I ask it so often, my listeners actually dubbed it the Jason Hartman question. Now, clearly I did not make the question up, okay? But I'll take it, compared to what? Because I think that really is, Bryan, life's most important question. It's the most important question for any decision we face in life, not just whether to buy or sell a house, for anything, right? We're going to always ask ourselves, even subconsciously, compared to what? To know if anything makes sense, to know if something is true or false, to know if it's valuable or not valuable. Compared to what is always the question. And I think it's life's most important question. So I created an index around this for real estate. I call it the Hartman Comparison Index, or the HCI for short. And if you look at gold, gold has been considered money for thousands of years. Now, I'm not a gold bug. I don't think gold's a very good investment. It's okay. It's insurance, right? But that's about it. It's very one-dimensional. Buy low, sell high. That's about it. And oddly, even with all this inflation we've got, gold hasn't done much of anything. And Bitcoin's gone down. So that's supposed to be digital gold, right? So I'm not a huge fan of these things, but they do offer a measuring stick. So with gold, if you look at 1972 gold prices 50 years ago, okay, the median house price was about $27,000 in 1972. Gold was $65 an ounce. So 50 years ago, if you wanted to buy the median price house, you would need 412 ounces of gold and $27,000. You could do either one. You could store your wealth in dollars or store it in gold and sell your gold, trade it for dollars, and use those dollars to buy the house. Okay, right? But today, the house price is about $357,000, and gold is $1,944 an ounce. Of course, these prices change hourly, so this is as of like 2 weeks ago. Okay, but it would cost 184 ounces of gold to buy a house today. So that begs the question: priced in gold, are houses cheap or expensive? Well, they're cheaper than they were 50 years ago by a huge margin. I mean, now you might say, well, Jason, 50 years ago, who cares? I wasn't even alive 50 years ago, you might say, right? But let's look at some different decades. Let's look at 1980. It took 97 ounces of gold to buy a house in 1980. So it's more expensive than it was in 1980 because today it takes 184 ounces. But in 1990, it took 228 ounces of gold to buy a house. Today it's cheaper, 184 ounces. In 2000, 22 years ago, it took 520 ounces of gold to buy a house. So today it's a lot cheaper than it was 22 years ago. Yet everybody thinks it's more expensive because 22 years ago, a house was $147,000. It's more today. It's $357,000. Not in gold, it's not. It's dramatically cheaper. In 2010, it was 158 ounces. That was, during the Great Recession. Okay, it's a little more expensive than it was 12 years ago, right?
Right.
But historically speaking, it's really not that expensive, priced in gold. But what else is there? Well, priced in gold, I say it's cheaper. How about oil? Oil is one of the most important commodities in the world. In 1970, oil was $4 a barrel and a house was $23,000. It took 6,400 barrels of oil to buy a house in 1970, 52 years ago. Today, it only takes 3,300 barrels of oil to buy a house. So if you were an oil investor and you saved based in oil, right? That was your investment of choice because, hey, everybody needs oil. That's what runs the world, right? You would think real estate is cheaper than it has been a lot of times in history. In fact, the only time, decade by decade, it was cheaper was in 2010, where it was only 1,900 barrels of oil to buy a house. Today, it's 3,200. Now, most people think real estate is more expensive this year than it was last year. But last year, it cost 4,489 barrels of oil to buy a house. This year, it's only 3,293. So priced in oil, it's cheaper than it has been at most times historically. Not all times. It's not the cheapest ever, but mostly it's pretty cheap. Priced in oil.
That's an interesting way to look at it too, with different things, because you're right.
Yeah.
oil, gold, all that kind of stuff. Those price it's compared to what? Whenever you say it's
Yeah.
expensive or not.
Those two things are important. But what about food? How about rice? Rice is the food stock for 2/3 of the human race. This is the base food that 2/3 of the human race eats. Okay. It's a very important commodity. 1970. Now, this is called hundredweight rice. Okay. So that's what we're measuring it in. That's how they measure it. 43,000 hundredweights of rice to buy a house in 1970. Today, only 22,000. It's actually cheaper than it was 52 years ago today. Now, let's look throughout history, though. It's cheaper than it was last year. It's cheaper than it was the year before in 2020. It's a little more expensive than it was in 2010. So in 12 years, you need about 2,000 more hundredweight units of rice to buy a house today. But in 2000, 22 years ago, it was more expensive than it is today. In 1990, it was cheaper, just over 17,000. In 1980, it was super expensive, the most expensive in the last 52 years. 62,000 units needed to buy the median price house in 1980. So in rice, is it cheap or expensive? It's cheap. How about the S&P 500 index? Let's compare it to stock prices. Okay. 1970, 249 shares of the S&P to buy the median price house. 1980, 466. 1990, 286. 2000, 112 units of the shares of the S&P. In 2010, 136 shares of the S&P to buy the median price house. In 2020, 82 shares. Last year, 74 shares. That was the cheapest on my chart. Today, it's 79 shares. So overall, it was a little cheaper last year, but if you throw last year out, it's cheaper than it's ever been. Isn't that amazing?
That's crazy.
Now, granted, I'm not taking every single day of the last 52 years on any of these charts. I'm doing it decade by decade. Okay. So, yeah, interesting.
Yeah, that's really interesting too. So, what I'm taking from that is keep buying real estate.
It's cheaper than most people think it is. It really is. But, it begs the question, and maybe we'll wrap up with this. Is it really about the price of the house, or is it about the payment, the monthly payment on the house? That's really how most people measure it. So let's compare not the price of the house, like we're paying cash, but let's say we're paying monthly in shares of the S&P, gold, oil, rice, whatever you want. There's a whole bunch of commodities in the Hartman Comparison Index that we use to compare the price of real estate to these different things, okay? But let's measure it in the monthly payment. Okay, so first off, let's take the monthly payment and adjust it for inflation. So this is dollar for dollar, but it's the value of the dollar at the given time based on inflation debasing the dollar or devaluing the dollar. Okay, great. So in 1970, where we start, the mortgage payment on the median price house was $127. By 1980, that mortgage payment rose. We had much higher interest rates in 1980 to $639. But we also had a lot of inflation in that decade. So if we take the $127 in 1970 and we calculate according to the official numbers published by the government through the Consumer Price Index, how much is that $127,1970 worth in 1980? And adjusting for interest rates and home prices, it's $310 per month. So it got a lot more expensive to own a house in 1980 than it was in 1970. But let's fast forward to today. If we go back to 1972 or any decade in between, we see that old payment of $127, we bring them forward into 2022 and we adjust for the house price and the interest rates and inflation, we're paying $195 today. So it is more expensive than it was 52 years ago, adjusted for the official inflation rate But wait a sec. Remember we talked about how the official inflation rate is understated and how it's a big lie? So there's a website. I interviewed the founder on my show, on my podcast. It's called shadowstats.com. A lot of people have heard of this website because what they do is they go back and they measure inflation the way it used to be measured before they started manipulating the index so much around 1980. Okay. And the shadow stats number tells us that the 1972 mortgage payment is now only $58. Less than half of what it was 52 years ago. Yet everybody thinks houses are so expensive. And look, if people have their head spinning, I know this a lot. If someone hasn't followed my work or heard me talk about this before, I know this can be a lot to digest, especially if you're only listening to audio and not seeing the visual aids. Okay. Which, by the way, these slides are available. You can just go grab them. They're totally free. Just go to jasonhartman.com/slides and you can pick apart these numbers all you want. I'd love to hear what you think. I've, certainly had my share of critics saying, hey, what about this? What about that? I love that, because it makes me think. So just go to jasonhartman.com/slides. You can download the slides. Okay. So they're available for you. But if houses were expensive, you have to ask yourself just this simple question. If they were so expensive, why wouldn't they go down in value? Why wouldn't the market adjust the price and resist the expensive price? Why wouldn't the market reject it? I mean, look, when things are too expensive and I'm a consumer, I don't buy them. I just spend my money on something else. I'd say, hey, this is a ripoff. It's too much. I'm not going to do it. I don't care how rich I am. I just don't like getting hosed. Okay. Even if I'm rich, it doesn't matter. Right. So the market would be rejecting these prices if they were too high, but they're not. There's no inventory. Everybody keeps buying everything that goes on the market, sometimes with multiple offers way above the list price. So people inherently know that real estate is not really that expensive. Yet the stupid news media keeps saying it's expensive. But yet people keep just buying and buying and buying because it's really not that expensive. So it's less than half of what it cost 52 years ago in terms of the mortgage payment by the shadow stats, more accurate inflation calculations. Okay. But okay, that's just inflation numbers. That's all manipulated, people say. Okay, well, we can compare it to other things. Ounces of gold, it's cheaper. Barrels of oil, it's pretty cheap. Okay. Shares of the S&P, cheapest it's ever been. Okay. Hours worked. Here's a good one. Okay. Let's stop at this one. How many hours does the average person, the person at the average wage, need to work every month to pay their mortgage? In 1970, they had to work 41 hours. In 1980, they had to work 45 hours. So it got a little more expensive. You had to work 4 extra hours in 1980 to pay your mortgage. In 1990, it got a little cheaper, only 39 hours, 2041 hours, 2010, 34 hours, 2020, 40 hours to pay your mortgage every month. Today, it's 55 hours. So it is more expensive in terms of the number of hours, the amount of labor the average worker needs to trade to pay their mortgage. It's more expensive. Actually more expensive than at any time on my chart. But that begs the question, who's buying the houses? Is it the average worker? Or is it people who are making above average income? And I say it's people making above average income. Workers are getting left behind. It's been very unfair until from 1977 to 2017, and Trump really did change this and improve this for average workers. There was no real dollar increase in pay for the average worker until 2017. That was the first time in really 4 decades that there was any real increase for them. So it's been a little better since, but now that we've had so much inflation, they're falling behind again. I mean, you look at gas prices, you look at I mean, so many things are just inflating ridiculously. Okay. So that's just interesting to look at. And that's why I wanted to pause there. Okay. So we did that. So that's the Hartman Risk Evaluator in a nutshell. There's a lot more to it, a lot more stuff we didn't have time to go over. And I really encourage people, just grab the free slides, jasonhartman.com/slides, and you can look at this and pour over it to your heart's content. In fact, I not only have these slides there, but I have my slides from 2 other presentations, some longer, some are shorter presentations I've given, that people can just go grab those. Okay. Hope it helps.
Yeah, that's awesome. Yeah, guys, definitely go grab those slides. Hey, Jason, do you think the employment, the wages are going to catch up too?
In real dollar terms, probably not. In nominal dollars, yes, people will get a raise, but in real dollars, they'll probably fall behind. And as they have been for a long, long time. I mean, the only time we saw a reversal was under Trump in 2017. We started to see some real progress there for the average worker because, he was really trying to onshore things and make employment better in the US and reduce immigration, which lowers wages because it puts more workers into the workplace competing for those jobs. And, someone from Mexico is just going to work for less money than an American will. So you create more competition and the price is going to go down like anything.
Makes sense. Yes, this is some good info. Hey, again, guys, if you're listening to this on audio, go check out go check it out on our website, the video or YouTube. You can see it, and then also download the slides. Hey, Jason, is there anything else we missed here, or we pretty much cover everything?
You can never cover everything. It would take days to to go through all of this stuff, but I think it gives people a good idea. The most important thing is not really even the data I shared. It's just to learn how to think about it, right? To understand that the dollar is a moving target. If you want to know the value of anything, you should not just compare it to one thing. You should compare it to multiple things. And certainly the one thing you pick should not be something that's a moving target like the dollar. The dollar is just one thing to compare to, and it should be one of many. Because look, all of the commodities that I mentioned, whether it be gold, oil, rice, I mean, in the index, there's a whole bunch more. There's haircuts, there's just a zillion things in the index, okay? And the index overall says real estate is still just not that expensive. It's more expensive than it was a year ago, for sure, but it's not that expensive yet. And so just make sure you're using a lot of comparisons whenever you try to value anything in life, not just real estate. Just knowing how to think about it is more important than the specifics I mentioned. But if you go and download the slides for free, jasonhartman.com/slides, it'll give you a lot more information. There's way more on those slides than I've presented today. It would take hours to do that. Okay.
Yeah, and that's a good point you brought up too. Just think about compared to what, like actually think about it. Like don't listen to the media telling you all this kind of stuff. Look at the market and use your head a little bit.
Yeah, absolutely. Good point.
Yeah. Hey, well, Jason, thanks for coming on. Yeah, we appreciate it. And hey, for everyone listening, check out jasonhartman.com. The slides are at jasonhartman.com/slides. And until next time, go out there and crush it and close some deals.